Except for China, Donald Trump has secured trade deals with major partners, including the EU and Japan. However, the impact of tariffs tend to lag. We could start to see signs of it as soon as this week. Meanwhile, markets are reaching all-time highs. So what does this mean for investors? What could shake the rally? Lesley Marks, Chief Investment Officer, Mackenzie Investments, joins us now to talk some more about this. And what a rally it's been. Record highs across the North American markets yesterday. A month that is typically quieter in late summer. Is this coming from earnings, muted inflation, Lesley, or both?
Well, I think there's a whole bunch of things, but earnings are certainly top of mind because we're just sort of coming through earnings season. And I think earnings in general have surprised on the upside. I saw a statistic recently that 80% of S&P 500 companies beat on earnings expectations. So that's an indication of a very strong earnings season. Now, having said that, of course, there's another 20% that hasn't beat. And that 20%, I mean, you're starting to see companies that actually are being impacted fairly directly by higher costs due to tariffs. So where companies missed, they missed by a lot, and they were punished by the market.
Even some of them that missed by a lot, even some of them that missed not by much seem to get punished by the market. Is that just where we are?
That's right. I mean, when you have an environment or a backdrop where 80% of companies are beating expectations, those are the companies that are going to get all of the attention. We also saw outsized gains in the largest companies in the S&P 500. Those tend to be more in services sectors as opposed to goods, so they're less impacted by tariffs. So you saw outsized beats and outsized stock returns. And people often refer to the Mag 7 as, you know, the stocks that have been driving the market. And if you look at over the last 4 months since Liberation Day and the rollback of tariffs or the 90-day reprieve, in that 4-month period, there's a huge delta in performance between what the S&P did in returns and the S&P equally weighted, which is an indication of the concentration of returns in a few stocks.
Considering how lopsided this is, do you think it's sustainable?
Well, that is the question that is certainly on every investor's mind right now. And there are some things that would lead you to believe that it could be sustainable. So I'll start there, and then I'll talk about some of the risks that we see. So why would this be sustainable? Well, first of all, we already talked about earnings. Earnings are the fundamental that really drives stock price performance. So if earnings continue to be strong, continue to beat and surpass expectations, that earnings momentum will continue to drive equity prices higher. The second piece is, what will we pay for stocks? What we pay is often largely determined by sentiment, which is generally very positive, as we've seen, and interest rates. Well, more recently, based on the CPI data that we saw, it looks like we're well positioned to see an interest rate cut by the Fed or resumption in the cutting pattern starting in September, which will be very good for equities, which is why we had such a strong equity market yesterday in response to the as expected CPI number, because this is the issue that many people are pointing to is going to be impacted by tariffs, which is inflation.
Yeah, you say tariffs are the biggest risk, right?
And exactly. And then when we turn to the risks, there's still a risk that although we've seen fairly muted CPI numbers or inflation numbers, that the impact of tariffs is still not fully, digested by companies. And there's a few reasons for that. One is that companies are absorbing the tariffs, so consumers are not seeing those in pricing. The second is that the goods that consumers are buying now were all purchased in the first quarter or earlier in the year. Remember, there was a lot of front loading. So the cost of those goods still continues to be low because that is before the big tariffs came in, which was kind of in that June, July, and now August period. So just because we haven't seen tariff impact yet on margins, on pricing, doesn't mean we won't in the next 3 or 4 months.
I was going to say, what's your timeline? What's your expected rollout for the effect of the tariffs? Do you think it'll be before the end of the year?
I think if we're going to see any impact, and remember, I always talk about this as a fixed pie or a zero-sum game. $250 billion or $300 billion in tariffs coming into the U.S. Treasury has to be paid by someone. And I think it would be a false narrative to say it's being paid by the exporting countries, because technically it is paid by the importers. And so whether that gets priced or passed on to consumers or companies eat that, somewhere along the food chain, someone has to eat that cost.
I do want to ask you about trade deals as well. Canada has not worked out a trade deal as anticipated. That deadline passed. Do you think it'll happen by the end of the year? And do you think we'll end up in that range we've seen some of the others, that 10 to 15%?
Well, Canada is a really interesting scenario right now, because I think expectations were set that we would have a trade deal within 30 days of the G7 meeting, and we did not see that. So, and we've really slid from there. So that's been very disappointing for people looking at Canada as an investable market. The other issue with Canada is the tariffs that we've seen. People have to remember that about 80 to 85% of goods that are exported from Canada into the United States fall under USMCA. So the tariffs that we've seen, while the numbers are high and higher than what we've seen in other regions, as you noted, that it only impacts a small amount of our goods. Now, where we have some concern in seeing this trade agreement deadline slip is we're starting to get closer and closer to the point where the president will want to reopen negotiations on USMCA. And I think that that poses a bit of a risk. I think based on the pattern of maximum leverage that the president has tried to use in other trade negotiations, he is more likely to link USMCA negotiations to the Canada-US trade agreement that we thought we would already have by now. So I think that the risk profile for a trade agreement for Canada and the U.S. has actually increased, and it will day by day.
Meaning that it'll be a wider negotiation than we anticipated and more things could get hit?
Exactly. And I think the idea that 80% of goods that are traded between our two countries or regions, we can't count on that. Many people are looking at that saying, oh, well, the trade, that the high tariffs of 35 or 50% in aggregate to Canada isn't as big of an impact because it only impacts 15 to 20% of our goods traded with the United States. I think we have to start to think, well, could this be bigger under a different USMCA set of terms?
Got it. All right. We do have to leave the conversation there. Lesley, good to see you. Thanks for joining us.
Thank you, Morella.
Lesley Marks, Chief Investment Officer, Mackenzie Investments.